Welcome to Alpha Talks, Seeking Alpha's Editors Roundtable. What moved markets this week? The week ending Friday, March 5th, 2021, the first week in March. What a week it was. The week started off positively enough with a nice rally on Monday and then kind of went into a bit of a tailspin. Thursday was the biggest loss so far. All of this caused by one Jerome Powell and his unwillingness or inability to engage in yield curve control. We sold off pretty dramatically after that became clear on Thursday. This morning, Friday, there was a brief little rally after the non-farm payrolls surprised to the upside, but that then faded. But now at this moment, as we speak, the Dow is back into positive territory. This is at noon on Friday. I suggest that to potentially change again in short order. So let's not get too much ahead of ourselves. But I am curious what my co-panelists have to say about all of this. And let me introduce them now. In no particular order, Brad Olison, the VP of News, Kim Kahn, Senior News Editor, and Stephen Alfer, Managing Editor of Breaking News. I am your host, Nathaniel E. Baker, Senior Editor of Strategic Contributors here at Seeking Alpha. All right, let's kick off with Kim as we normally do to give us the big picture laid out and the view of where things are right now.
Yeah, well, if we start with what just happened today is kind of a little snapshot of how the week's been run. We had the big headline payrolls number, which is more than double expectations today, big jump in private sector employment. And then we had a little head fake, but right after in the stock market and the bond market, yields really spiked up to recent highs, 10 years above 1.62% briefly before easing back. And that's just more inflation concerns for the bond market, it seems like, and that's what has been hitting stocks through the week. That kind of turning point with Jay Powell's comments when he was talking in the Q&A session. They really pressed him on whether he was going to do Operation Twist Part 3, which is kind of trying to flatten the yield curve essentially by selling short-term bonds and buying longer-term bonds. And he naturally dodged any kind of direct answer to that question, but it seems like the bond market and their spike afterwards, was concerned about his dovishness. I mean, he was pretty much saying the Fed can be very patient for a long time, and the bond market, in fact, was saying, "Well, we're more concerned with inflation. We're not going to be patient. We're going to push yields up," and they spiked right up, and that hit the high-value tech stocks. And Powell's going to be entering a quiet period soon ahead of the March 17th meeting the FOMC has, and I think he'll be welcoming that because he's kind of in this no-win situation where they don't really want to do a Operation Twist, but he doesn't want to say he's going to be tough on inflation and kind of hit expectations there and hit growth there.
Yeah, not to get ahead of ourselves on the discussion here, but I do not understand why the market is holding Powell, or anybody is holding Powell responsible for yield curve control at this state of the game. I mean, shouldn't the 10-year be doing shouldn't bonds be selling off at this stage of the economic cycle? And in many ways, isn't this doing exactly what the Fed wants it to on some
100%, 100% net. The rise in yields has been quite modest. Yields should go higher as the economy improves, and the economy is improving. It's opening up. Travel and leisure is coming back. Restaurants are coming back. Texas is wide open now. Mississippi, even states like Connecticut and quietly my state of Pennsylvania, those governors are quickly reopening. So yeah, I would take exception to almost all the kind of the memes now that Jerome Powell and his refusal to do yield curve control or something like that was responsible for the crack up. We had bubbly equity valuations in a number of sectors, EV, being one, even a company that's actually making tons of money like PayPal just go way too far, too fast, and they're cracking a little bit, and it's kind of healthy.
Yeah, let's get to Brad on the winners and losers. I forgot to mention one section here that's quietly done quite all right this week is energy. You know, we did have OPEC, the announcement yesterday, which helped. But to your point, Stephen, for energy prices to be higher, you also need demand to be strong. Demand would probably not be strong if the economy were in really bad shape. But anyway, curious about the winners and losers. Brad, take it away.
Yeah, I mean, as we all alluded to, no surprise here, the winners this week were obviously in the energy category. Diamondback Energy, Occidental, Devon Petroleum, partially due to the OPEC staying put on some of its output, but obviously it had been a gainer for quite some time leading up to this week, as this reopening trade, as Steve was pointing out, starts to pick up steam. You know, Norwegian Cruise Line again cracking the top performers this week. Obviously, one of the most hard hit names during the pandemic, and as we already alluded to, the yields rising has kind of taken some of the steam out of what Steve calls bubbly valuations in the tech names. You know, Salesforce.com, Twitter, and even Tesla were huge losers this week, along with rate-sensitive names and REITs, sort of like American Tower was among the biggest losers, and that's partially attributed to the yields rising, which should be associated with a stronger economy. And I think we touched on this last week when we were discussing whether the yield rise is a bad thing for equities or not. And it always comes down to whether the why associated with that. And as Steve also mentioned, this is kind of healthy, right? The yields now on the 10-year are still below what they were pre-COVID. So it seems to me that the yield play is not as negative for equities as it would be if the economic tailwinds weren't exactly there.
Yeah, I guess the one unique thing is that you had the sell-off in bonds and the sell-off in stocks at the same time. These last
certain stocks, right?
You're right. So it was only certain stocks. Yeah, some stocks have quietly done very well, like the energy sensitive names that we mentioned and the others that you just mentioned. Stephen, what else were you watching in the way of corporate news and other things?
Kind of one big piece of corporate news that kind of went under the radar because of so much else going on was Berkshire Hathaway and Warren Buffett with his annual letter over last weekend. It's very interesting. He's kind of taking a big deal off the table, but they've been buying back stock. So they're still kind of putting money to work. They're putting money to work in their own stock. But it's interesting, the performance in Berkshire Hathaway. To me, it's kind of like an old economy stock, and about the time when Buffett starts getting trashed, or when we start ignoring him, is about the time when, the hot names are going to start coming down, and Berkshire's going to start doing what it normally does, which is outperforming the S&P 500. And Berkshire is actually higher on the week. It's nicely higher year to date. It's way outperforming the S&P 500 and the Nasdaq. It's actually outperformed both those indices over the last 6 months, and is really close to actually outperforming the S&P over the last year. It's nowhere close to the Nasdaq over the last year, just to show you how far the Nasdaq has gone ahead. So I found that to be a really interesting bit of corporate news, and would highly recommend folks go back and look at our story on it, and read Buffett's letter. It's great stuff.
Yeah, he also reiterates his call not to bet against America and American stocks under any circumstances, which he said before. But look, Buffett's been vindicated several times with his picks, and some of these newer entrants to the game of investing, I'm not going to mention any names, David Day Trader, Kathy Wood, et cetera, have a bit of a less of a track record. So we'll just have to see how that all turns out. All right, let's move on to the next segment of the show, where we discuss our favorite news coverage or other stories, articles that we've edited or read, sometimes even written. Kim, you've been quiet for a while, so let's start with you.
A couple of quick ones. Just going back to yields. This week, Guggenheim's Scott Minerd was out with his call saying that he expects the 10-year yield to keep dropping and trough around negative 0.5% sometime early next year. His chart is kind of regression analysis, which he calls the drunken man in the snow chart. It shows that there may be staggering left, right, and center, but the direction is towards home, and that's where yields are going. They're going home, and it's down.
I mean, Minard's call is pretty contrarian. I mean, for yields to drop all the way back down there, I mean, you'd have to have a lot of risk off. And how are you going to get that, especially if the Fed doesn't do anything, is an open question. But he's a smart guy. I don't want to second guess him on that, but we'll see, man. I mean, that is a pretty big call.
Yeah, it's huge, and especially when you consider that fiscal stimulus is still yet to come. You're kind of betting that the bond market's going to discount the entire recovery for this year. So it's definitely a big contrarian call.
All right, Brad, what about your favorite story?
So I guess just touching on some of the themes of going too far too fast. I don't want to say that they have gone too far too fast, but the market has told us that they may have gone too far too fast. And I think that comes into the electric vehicle story. One of our editors here, Clark Schultz, has long talked about the Tesla halo, this ability for the Tesla's valuation to lift all the boats in the space. And that has now come off entirely. We're talking about Tesla being off close to 20 plus 25% since the February announcement that they were jumping into Bitcoin. I'm not making a connection between the two. But it is just interesting that pace of decline matched within a couple tenths of a percentage point the same pace of decline that Tesla shares had during the peak of the COVID fears. So a little bit of the shine has come off that name, which prompted Wedbush to come out and massively defend the space, calling it a massive buying opportunity to be, just pile into electric vehicles wholesale. We've seen a lot of these names take a hit. Fisker, I think even NIO and XPeng and Li Auto, these were all these names that Wedbush said that would probably be great opportunities for people to get involved with.
Stephen, what about you? Favorite stories?
Our editor, Jerry Cronenberg, not long ago, just put up a story about basically the SPAC bubble is fully cracked. The air has really come out of it. You have a lot of kind of high profile pre-deal SPACs that were trading at crazy premiums to their prices. Bill Ackman's Pershing Square and Tremass, one of his latest, which is IPOF. I'm not sure what it's called, Social Capital something or other. They're plunging. Even Liberty Media, which was trading at like a 45% premium post its IPO, it's down to about a 10% premium. So these were SPACs that were trading at above the IPO price, even though they haven't inked a deal yet, just in kind of anticipation of that.
Well, on that note, let's wrap it up for this week. Thank you all for watching and listening, as the case may be. If you are watching and want to hear the full audio version, it is slightly longer than the video version because the video is a huge file if I leave all of the stuff in there. So I have to edit some stuff out, but that all stays in the audio version, which is out Saturday mornings around 6:30 a.m. through the Wall Street Breakfast podcast account. Get that there. Thank you again for watching and listening, and look forward to speaking to you again next week.